While Wall Street celebrates the US dollar rallying to new heights, do you know that half a world away, central banks are bleeding their foreign reserves just to survive? A stronger dollar is never just a green flashing light on a trading screen. For emerging markets from Southeast Asia to Latin America, it is an invisible hurricane, a silent liquidity squeeze that chokes local businesses overnight. Which nation will break first? Think about it. When we read the headlines about traders cutting Fed rate cut expectations or global capital rushing into safe haven assets due to geopolitical friction, it sounds like an abstract macroeconomic game. But in reality, it triggers a brutal domino effect. Every single time the greenback flexes its muscles, global financial conditions tighten like a noose. Commodities get pressured, local currencies collapse, and domestic interest rates are forced upward, suffocating local growth. If you are holding assets in a developing economy, or if you think your portfolio is insulated from the drama in Washington, you are overlooking a massive systemic threat. The dollar isn't just growing stronger, it is actively vacuuming cash out of the global banking system. So, how exactly does this liquidity trap function behind closed doors? To understand how this storm threatens your money, we have to look past the surface-level exchange rates and dissect a hidden reality through a critical framework from the Bank for International Settlements. Let's dive into the dark side of the US dollar. To understand why this storm is so dangerous, we have to look at the very nature of global capital through a critical report from the BIS, the Bank for International Settlements. They fundamentally view the US dollar as the lifeblood of the global financial system. And when this specific artery constricts, the weakest tissue in the global economy necrotises first. Let's dispel a massive myth right now. Most retail investors look at the dollar through the lens of the DXY index. They see a chart going up or down against a basket of other major currencies, like the euro or the yen. They think, okay, imports get a bit cheaper, exports get a bit pricier, no big deal. But the macro giants, they don't look at price, they look at liquidity. According to the BIS, the US dollar is the undisputed heavyweight champion of global debt funding. It is the plumbing of international trade. When a corporation in Brazil, an energy firm in South Korea, or a property developer in Vietnam wants to expand, they don't just borrow in their local currency, they issue debt in US dollars. Why? Because international lenders demand the global reserve currency. It's stable, it's trusted, it's highly liquid. Until it isn't. Here is the exact mechanism of how the Vong toy, the dark circle of the dollar, gets triggered. When the Federal Reserve holds interest rates higher for longer and geopolitical tensions flare up, two things happen simultaneously. The dollar spikes and volatility explodes. Suddenly, the cost of hedging that currency risk, what we call hedging costs, goes through the roof. Imagine you're a major international bank in Tokyo, London, or Frankfurt. You have billions of dollars lent out to businesses across emerging markets. When hedging costs skyrocket, your risk models flash red. The cost to protect your capital suddenly outweighs the yield you're pulling in from those loans. What do? You don't double down, you de-risk, you pull back. To protect your own balance sheet, you begin to shrink it. You stop rolling over short-term loans. You demand your dollars back from overseas borrowers. This is the exact moment the global banking system switches from asset expansion to capital preservation. The commercial banks start vacuuming dollars out of foreign markets and repatriating them straight back to the US mainland. Now, look at this from the perspective of an emerging market economy. Suddenly, local companies wake up to a brutal reality. They have massive dollar-denominated debts maturing, but the international banks have completely cut off the dollar supply. The local currency is plunging against the greenback, meaning it takes vastly more local cash just to buy the same amount of dollars needed to service that debt. This triggers what the BIS calls a liquidity crunch. The domestic economy is suddenly starved of oxygen. And here's the ultimate twist that blows retail investors away. Draining capital out of these developing nations has almost nothing to do with their local economic health. Your country could have a roaring GDP growth rate. Your local companies could be highly innovative, boasting pristine factories and surging domestic sales. It simply does not matter.
When the global dollar shortage strikes, foreign institutional funds are hit with massive margin calls back home. They are forced to sell their most liquid, highest-performing assets abroad just to raise the dollar cash their prime brokers are screaming for. They aren't fleeing your country because your economy is bad. They are fleeing because they desperately need cash to plug their own holes on Wall Street. It is a forced, mechanical liquidation. Foreign equity funds dump local blue-chip stocks. Fixed income funds dump local government bonds. They pack their bags, convert everything to USD, and head for safety. This leaves behind a massive vacuum of capital, completely crushing asset prices, real estate, and equity markets across the developing world. It is an agonizing squeeze. The dollar strengthens, liquidity vanishes, and the domestic central banks are backed entirely into a corner. They are left with two equally devastating choices: raise interest rates to defend the currency and kill domestic growth, or stay quiet and watch their economic sovereignty burn. So, where exactly is this pressure building up the most right now? Which regions are sitting directly on top of this macroeconomic fault line? Let's shift our focus to the real-world casualty list and dissect the heat map of vulnerability across Southeast Asia and Latin America. Teaser alert: the nations you think are completely safe might actually be the ones closest to the edge. Now, let's pull up the global vulnerability heat map. This isn't just an academic exercise. This is a financial medical record of which developing economies are currently running a high fever and which ones are headed straight for the intensive care unit. When you look at this chart, the color coding tells a brutal story. The darker the red, the higher the concentration of dollar-denominated debt, and the thinner the buffer of foreign exchange reserves. But there is a fatal mistake that the vast majority of retail investors make. They look at a country's trade balance and think, hey, this nation exports a lot of microchips, commodities, or textiles. They have a massive trade surplus. They are perfectly safe. The reality is far more ruthless. A trade surplus means absolutely nothing when short-term dollar debt is what suffocates a corporate sector overnight. Let's dissect exactly why. Trade revenue trickles in gradually over 12 months, but debt? Debt matures on a specific, unyielding calendar date. When a multi-billion-dollar debt tranche comes due, an emerging market corporation cannot pay the lender in local currency. They cannot pay them in physical goods sitting in a warehouse. They need cold, hard US dollar cash on the barrelhead. Look at the hot zones on our map right now, particularly across vulnerable pockets of Southeast Asia and high-debt nations in Latin America. Their corporate balance sheets look like a ticking bomb because of a massive mismatch. They earn their revenue in local bante, but they owe their capital in greenbacks. As the dollar rallies, these countries face a devastating dual pressure, a financial pincer movement that crushes economic growth from both sides. First, look at the currency defense. To stop their local currency from going into a freefall, which would instantly trigger hyperinflation through imported energy and food costs, central banks are forced to step into the open spot market. And what do? They start quietly, desperately, burning their precious foreign exchange reserves. They sell their stockpile of US treasuries to buy up their own crashing currency. It is a desperate, short-term band-aid. You are essentially burning your house's foundation just to keep the living room warm for a few more days. According to historical data, when a central bank's reserve cover drops below the critical 3-month import threshold, the market smells blood in the water. Speculators move in, short sellers aggressively attack the currency, and the flight of capital accelerates from a jog to a panicked stampede. But it gets worse. Burning reserves is never enough. To truly halt the bleeding, these central banks are forced to execute the second jaw of the pincer. They must raise their domestic interest rates. Think about the sheer irony of this situation. Their domestic economies don't need higher rates. Local inflation might be perfectly under control, local consumer demand might already be sluggish, and small businesses might be struggling to stay afloat. In a normal world, the central bank should be cutting rates to stimulate the economy, but because of the skyrocketing dollar, they are forced to do the exact opposite. They are forced to jack up interest rates purely to make their local bonds look attractive enough to keep foreign investors from pulling their cash out. This is a defensive stranglehold. By raising interest rates to protect the currency, the central bank intentionally barks a halt to domestic credit expansion. They make borrowing prohibitively expensive for local businesses. Mortgage rates spike, consumer spending dries up, the domestic stock market loses its valuation floor. In plain terms, they are forced to sacrifice their own domestic economic growth just to pay homage to King Dollar. If you look closely at the balance sheets of corporate titans in these red-zoned markets, the pain is already visible.
Their cost of capital has doubled. Their cost to import raw materials has expanded by double digits, yet their ability to raise prices for a squeezed domestic consumer is completely hitting a wall. Profits are compressing at an unprecedented pace. This is the exact anatomy of a sovereign financial crisis before it hits the mainstream media headlines. It starts on the corporate balance sheet, moves to the central bank's reserve depletion, and ends with a sudden capital freeze. So how does this macroeconomic tragedy directly infect the ground level? How does this systemic pressure translate to the companies you own in your portfolio, and what does it mean for your personal cash strategy? Let's advance to part 3, where we bring this massive VMO reality all the way down to your brokerage account and reveal the specific asset class rotation required to survive this global wealth transfer. Let's bring this massive VMO storm right down to your doorstep. How does a soaring dollar translate directly into the performance of your brokerage account? It starts with an invisible erosion of corporate earnings. Think about the companies in your local market. Any business that relies on importing raw materials, whether it's energy, industrial metals, or agricultural inputs, suddenly watches its cost of goods sold explode. Why? Because those international commodities are priced exclusively in USD. Even if their local sales remain steady, their profit margins get utterly hollowed out. Now pair that with the corporate trifio problem we discussed earlier. When a local company carries foreign currency bonds on its balance sheet, a rising dollar forces them to revalue that debt. Overnight, their liabilities expand on paper, striking a direct blow to their net income. But retail investors, the most immediate pain isn't felt in the earnings reports, it's felt in the daily market liquidity. When the dollar builds intense momentum, foreign institutional investors don't wait around to watch their returns get eaten alive by currency depreciation. They look at the shifting macroeconomic tide and hit the sell button. This triggers a massive systemic ETF outflow. Foreign capital aggressively pulls out of emerging market equities and fixed income products, heading straight back to the safety of US cash or short-term treasuries. When these giant funds liquidate their positions, they dump the most liquid blue-chip stocks first. The heavy institutional selling volume completely breaks the technical support levels of the domestic index. Domestic retail investors, seeing the sea of red on their trading apps, panic and join the sell-off. Suddenly, your local stock market enters a liquidity desert. Traded volumes shrink, bid-ask spreads widen, and even fundamentally strong, debt-free companies get dragged down in the crossfire. So knowing this, how do you defend your capital? How do you position your portfolio so you aren't just a passive casualty of King Dollar's rampage? This is where you must pivot from defense to active structural rebalancing. The traditional retail playbook of blindly holding localized paper assets during a dollar squeeze is a recipe for wealth destruction. First, let's talk about cash allocation. In the middle of a global dollar funding shortage, nominal cash in a weakening local currency is a melting ice cube. However, strategic liquidity is essential. Holding a portion of your portfolio in actual USD or highly liquid USD-pegged cash instruments gives you an immense tactical advantage. While the rest of the market is forced to liquidate quality assets at fire sale prices to meet their debt obligations, you sit on a pristine fortress of dry powder, waiting for the ultimate bottom. Second, you must understand the critical role of hard assets, specifically physical, non-custodial assets that carry zero counterparty risk and cannot be devalued by a desperate central bank. When global financial conditions tighten to a breaking point, history shows a white chalk pattern rotation. Paper promises fade and tangible scarcity wins. Assets like physical gold and silver act as a structural shield. They cannot be inflated away, they cannot be frozen by a stressed banking system, and they represent pure value density that thrives when systemic trust erodes. Furthermore, look at industrial hard assets like copper, the indispensable tech metal required to build out the global power grid and fuel the infrastructure demands of the AI revolution. When paper equity markets are drowning in currency volatility, these tangible, real-world resources maintain an unyielding baseline of utility and demand. By rebalancing away from highly concentrated local paper risks and anchoring a segment of your wealth in hard assets and strategic dollar liquidity, you completely change your relationship to the macro cycle. You stop fearing the dollar rally. Instead, you begin to view it for what it truly is, a temporary mechanical wealth extractor that is mispricing great assets and creating the buying opportunity of a decade. The pressure building up in the global system right now is undeniable. The pincer movement is closing in on high debt zones, and the liquidity drainage is accelerating. So what is the ultimate conclusion here? Is the dollar's dominance an inescapable trap for developing nations, or are we witnessing the final volatile stages of an overextended monetary paradigm? Let's move to our final section to piece this entire puzzle together, look at the historical endgame, and outline your immediate next steps as an investor. History leaves no room for doubt. King Dollar's aggressive rallies are never eternal, but the massive global stress test it leaves behind is deeply real, ruthlessly weeding out over-leveraged portfolios and debt-heavy companies before the tide finally turns. When this global liquidity squeeze reaches its absolute peak, the landscape completely changes. The nations anchored by ironclad foreign exchange reserves, alongside businesses that kept their balance sheet clean of foreign currency will be the ones standing tall. They won't just survive, they will inherit the market. This brings us back to your personal strategy. In a financial system entirely dominated by a soaring greenback and tightening liquidity conditions, you have to look in the mirror and ask a hard question. Is your capital standing on the defensive side, or are you just waiting to pull the short straw? Have you stress-tested your own net worth? What percentage of your hard assets have you securely locked away to prepare for the inevitable reversal of this global capital flow? Don't let the headlines dictate your financial destiny. Go check your asset allocations, evaluate your debt exposures, and position yourself ahead of the curve. But I want to hear from you. Where do you see the biggest vulnerability in the market right now, and how are you shifting your capital to withstand the dollar storm? Drop your insights in the comments section below, and let's get a high-level discussion going. Don't forget to hit like, subscribe, and share this video with fellow investors. Stay vigilant, protect your liquidity, and I'll see you in the next macro breakdown.